Welcome to StockOdds Odds and Ends. We're ready for February. This is our first week of February. Good evening, Rob. How's everything?
Hey, not too bad. Kind of
New
cool.
month.
It's February. That's the second month, the fourth day, and it's 2024. We got a lot of twos and fours in this conversation here. So anybody that likes numbers can look up all the good things about that. We're starting with Friday. What happened on Friday, February the 2nd? So that's 222024. We had a rally monkey. Now the thing with this day was we were up pre-market, and then we had the employment situation report and a bunch of other economic reports, but we dropped back to the previous close. You really have to evaluate where you've been. What is the high of the pre-market? What happened in the overnight session for sure? What's happening in other countries like Europe and so on? Just gotta get a feel of that. And then if you get moves, where do you go to? And we went right down to the previous close level. It had every opportunity to continue lower, but it held up there and it actually opened pretty much unchanged, and it was up a bit, but it rallied from there. We didn't go through the previous close, and we start to build on that. So important to watch for that, because we could have expanded either way. But remember, the market loves to try to test either the pre-market high or low, right? This is something that's an ongoing phenomena, right? It just likes to, if we've been up and then we pulled back, it loves to retest that. If we've been down, and then we rebuild, often, if it can't get through the previous close, it rolls over and goes back to test the pre-market low. And if that holds up, you could have a later day rally. So always watch that. Watch where you are also relative to volume weighted average price. Are you below that? Where, is it possible to go up and track back to that, which we did, and we went above it. And then we pretty much stayed above the VWAP all day. And then look for high signal type breaks. So this was a high signal move heading towards testing the pre-market, and then we had a high signal move where we actually broke above it. Very important. A little dipsy doodle that can happen. There was some incidences in the Middle East with the U.S. Targeting some things and stuff that pulled it back a little bit. There could have been other factors as well, but we eventually rallied, and again, another new closing high. So that's that. Here's the 15-minute chart of the whole week. So this is the week before on the Friday. Then we start Monday here. Here's our open price. We kind of built on Monday. We had a rally, and then we went sideways, kind of this wait and see ahead of the FOMC. Now we did dip down. Prior to that, there were some concerns, and we actually, kind of went lower. And we were chugging along, and then the FOMC announcement hit, knocked us down. And then during the Powell Q&A period, we rallied up strongly and then reversed again and went down and closed on the low. Well, you got to watch at extended hours. We never went lower than that close. We kind of started to already give a little bit of relief after the equities were closed for the day session. And the after hours started to build. I don't show that on this chart. But then we came in, overnight session went well, pre-market started to build, and then we opened here on February 1st, the first trading day. And remember, we've talked about the turn of the month effect, right? From one day, this was the last trading day of the month. And now our seasonality for January was supposed to be that the last trading day of the month is generally good for January, but we have a lot of other months of the year where the last day is bad. Okay, it's a down day, deleveraging, things like that. But really, this was a different event because we did have the FOMC and Powell, and the concerns were like, well, wait a minute, he's kind of talking like we're not gonna see the kind of interest rate cuts we thought, right? And of course, most people knew that already, but that was kind of like the market was just pouting and complaining that you don't get that free money coming in as soon as we want, right? So, but all things, all the economic reports and stuff like that were good. We did have some GDP. Everything said, hey, like soft landing, economic stuff's okay. Yeah, we're making some headway on inflation. And yeah, we may not get the interest rate cuts, but sentiment is kind of improving and people are not so concerned about their employment or lots of jobs, blah, blah, blah. Okay. So we built on there and then we have a follow through day here into Friday, continuing on. And of course, communications were a big driver. Meta was up 20%. So just a huge driver there. And that accounted for about 40% of SPY's movement, actually, right there. So that's how we finished the week. So we started here, we finished here. I just wanted to give it kind of a play-by-play thing. Here's the daily. So you can see the new closing high. So there's the dip that we had midweek there. And we finished strong. So, we're making new all-time highs in the SPY. This is the Qs. Now the Qs you can see, finished above slightly, but not quite that extended move that we had in the SPY. There's the price-weighted diamonds, just chugging along. More boring is beautiful type stuff going on there than the kind of moves you have in the SPY or the Qs. IWM is, it can have good days when the market's got this risk-on attitude and they're pressing the growth stuff and all that. It can have good days, but overall, it's still kind of trading in a sideways range here. It's not, performing like the other indices. So we're still in the best 6 months for IWM, so that doesn't say too much when it's just flopping along like a wet dish rag here. Sector performances for Friday in the week. Communication, of course, for Friday, that was largely Meta that did that. Consumer cyclical and technology. So really a risk-on day for Friday. Now, strangely enough, our risk-off list, the defensive list, did the best on Friday. And that's made up of short those guys and long defensive, healthcare, and industrials. So kind of in the middle of the pack. But the selections from StockOdds for our defensive list performed to the tune of, if I remember correctly, either 0.46 or 0.64%. So really robust return on the risk-off list. So you don't always have the fact that the risk-on sectors perform really well means that it's automatically going to be profitable for your risk-on list. It depends on which components have been chosen and what the odds of those particular symbols were for the day, that kind of thing.
And where we open too, that's important.
Oh yeah, exactly. Where we open right now. This in the Friday, we opened where we kind of just let's go back and look at that for a sec here. Friday's open here. So I can't see where it was pre-market in this chart, but well, here it is. Friday, sorry. We had that previous close. My brain's so full of things that got mixed up here a little bit. But we kind of opened without much of a premium. And I think possibly the reason that the defensive list could have done better is because we pulled back and maybe there was a lot of kind of change in attitude for the day, thinking that there was more risk since we came off that high and the employment situation report knocked us down. So they may have been pressing a little bit more some of the defensive stuff. So that's probably the explanation, eh, Dave?
Yeah, sounds fair.
Anyway, where we go here? So the 1 week performance, we had consumer cyclical, driven by Amazon was a good one for that sector. Consumer defensive. So we had more of a broad market rally for the week because if you look at consumer defensive, industrials, and healthcare, and technology wasn't in the lead for the week. Energy pulled back again. Real estate suffered a bit because of the interest rates. Basic materials suffered a bit because of the dollar. Utilities also affected by interest rates. Sector performances for Friday and the week. We had a really interesting relative volumes, that was on Friday. We had, some that were way over 1 and over 2 even. So volume was really robust for the week and for Friday, but it was a little bit softer earlier in the week because of the wait and see for FOMC, obviously. But after that kicked in, volume spiked. So people got back to trading, it looks like. For the sector performances, of course, you can see IWM, XLE, and real estate REITs and stuff down at the bottom, with XLY doing great, XLP, that's kind of cute when they're both performing pretty well, and communications here. Okay, map of the market for Friday. You can see the standout, NVIDIA again, AMD, Intel going the other way. Now with Meta up so much, you can't have in an ETF, you can't have everything perform to that degree. So when you get standouts like this, remember, as they rotate into that, or they cover their shorts or whatever has to go on, they have to sell other things, and so not all this is earnings related. This also is just what happens. And the ETF still performed amazing, but they can't all be up 20%. So something has to get sold, right? And so you got to think about that when you're involved in ETFs and symbols within ETFs. What has to happen if there's one going crazy? The same thing will happen in the Dow when Boeing goes crazy, or like even in consumer cyclical, when Amazon goes crazy, they're going to sell other things. So yeah, that's really interesting layout. And you can see that it wasn't that broad of a market rally on Friday, but when we go to the week, you can see it's more broad, but there's still a lot of speckles of red. And then you get this kind of weirdness here for the week with Google versus Meta, Microsoft versus Apple, NVIDIA versus Qualcomm, or the other ones. And even in the oils, Chevron versus Exxon. I love this stuff when you get them going opposite directions. And this is a related pair. But you can combine this and use our smooth indicators that we talk about to really do well on a pairing of something like this, especially when there's divergence between them. Same thing with Microsoft and Apple as competitors, Chevron, Exxon as competitors, Wells Fargo and JP Morgan as competitors. I mean, when you get divergence, it works really well. Daily chart of NVIDIA. I mean, do you want to short this thing? I've always said, like,
Widowmaker.
let's not be involved in shorting this thing. I've said this for a long time, and I'm not an advisor. I'm just saying that, it's a widowmaker in a lot of ways. Same as Meta too, right? Your thoughts, Dave?
I'm not sure any of these Magnificent Seven or whatever they call it these days.
Yeah, well, it's way up here. I mean, some targets have been up as high as 900, 950. So it wouldn't surprise me in the least. Well, the thing is, everybody's announcing they're loading up on their chips, right? I mean, Meta's buying their chips, and on it goes. Tesla's buying their chips. Everybody's buying their chips. So here's Meta, and this is the this is the weekly chart. I had to just pull up the weekly to show you how crazy that is. And from the kind of the end of 2022, it started to already turn. It had its low spot on that October. Remember that October 13th where we had the GDP come out, right? So that kind of was the low spot, and then it just been trucking along since then. Look at that high signal all the way. Oops. All the way up, and then this week, 20% move this week alone. So 40% of the S&P 500 move this week came from this one stock. Just think about that for a minute. So you go, that's not right. Well, it doesn't have to be right or wrong. It's what is, but it's weighting in it, and that performance, makes a huge difference. So up $80, 20%. It's crazy. So here's the US dollar. Dave and I were talking about, the channel. We were in a channel and we broke out. We said, be mindful of that. And it did impact the sectors that we talk about all the time. Then it traded sideways, and we had some dipsy doodle moves, from that. And then we get a big move again on Friday, right? So we're kind of breaking. We might do that again. It might go up and chop around, or we might see. There's going to come a time, I think, when the U.S. dollar is going to be really under pressure, and it might be a response to, more and more moving away from the dollar regarding commodities, especially oil. Other countries making deals in their currencies and things, and so there will come a time when the dollar will be really impacted, as we've seen in the past, but maybe even differently this time. But at the moment, it's holding up okay. And so every time it moves higher, there are certain sectors that are under pressure, right? Every time it moves higher. So let's see here.
And that's a technical term, dipsy doodle, right?
I think so. So here's the 10-year. So the 10-year went down on Friday. You can see that it was kind of moving higher, but it moved down on Friday significantly, and the dollar moved up, right? So that inverse relationship. Here's crude oil. Dave and I talked about this resistance up at 80, that it was possible for it to break and go higher, but it chose to reverse and head back down. It just could not make it through that 80 this time around. That being said, look at the XLE is actually sideways, so it's not being as impacted by the price of oil. It's hanging in there, so that might mean something. So if oil reverses back up again, maybe this will launch, since it's been exhibiting some relative strength related to the price of oil. Economic reports, Dave, take it away.
Yeah, there's just tons of Fed speak again. It's like every other day they have to have someone from the Fed speak. Monday, there's a little bit of service information, ISM services, and we'll get an idea of how service industry is holding up. Tuesday, there's like 4 Fed speakers. Wednesday, there's a little bit of info on consumer credit. We'll see how the consumer's holding up. Thursday, wholesale inventories and some jobless numbers, and then CPI revisions on Friday. But almost every day has someone from the Fed speaking. So that's just in the background that they could say something that moves the market a bit, but nothing major in terms of big announcements like last week. And in terms of earnings, just 3 major ones this week. We got McDonald's on Monday, and on Tuesday we have Eli Lilly with all their weight loss drugs, and then Wednesday Disney. So McDonald's has been raising their prices quite high, so they should be doing well. Got weight loss drugs. When you're back with Lilly, and then Disney again. They have all pricing power with their parks, so these may be pretty good earnings and show that the consumer is still holding up.
Right. Well, we did say that earnings this past week, could be market moving, and we saw that. And again, we're still in earnings season, so keep that in mind. And then after earnings season, we start to get more dividends, and then go back into some warning season and back into earnings season again. And that's how it works. Food for thought. Disruption of shipping continues. Some oil supply lines being changed because of it. So some of that can be inflationary, doesn't need to be showing up immediately, can be down the road, as we see a delay often between things that are happening globally and how long it takes to work itself through the system. But there's still a risk of expanded regional war, and now the U.S. Is more involved. Just so you know, there was a retaliatory strike against Yemen and so on, and then also some to do with Iran, but specifically in Iraq, related to things that were going on there. But the thing is, there's been tons of attacks against U.S. bases, and not all of them have been responded to. So to me, there's quite a bit of optics going on, because why would you announce that you're going to do something in a particular area before you do it? Seems kind of strange. So there's a lot of optics and maybe less efficacy. For some reason, doesn't seem that anybody really wants to go head to head with Iran, who's really the instigator of a lot of things over there. The troublemaker, but that's what it is. So just be careful of increased regional conflict over there. The market can respond to that. So you've heard talk of the Magnificent Seven. Funny, Dave, that you brought it up about the Mag Seven. Well, investors actually have dropped two of the seven, and it's now the Fab Five. So you've got Nvidia, Microsoft, canceled Tesla, Meta, Google, Apple is canceled, and Amazon. So Tesla may still be under pressure. They've got a fairly large recall both in China and in the US. Pretty much every single car they've sold has to be recalled, and they can update it through the apps and stuff like that. It's, there's things where like the size of warning labels and stuff on the instrument panel is not as large as it's supposed to be regulatory wise. So there's that kind of thing, but I don't think that's helpful. It still puts some pressure on there. And certainly the competition is increasing by the likes of things like Boyd and all that. So, okay. So this is what we've seen. I'm just saying, I don't know if it'll continue in the future, but so far it's gone from the Mag 7 to the Fab 5. And then what will China do related to Taiwan? That's still always a concerning question. It always intrigues me that these semiconductors are on fire and leading the market, and there could be this inevitable one-day risk that comes to the whole sector if this was to happen. So it's not necessarily the best. Like if I want to trade AMD, for example, I would like to pair it off with something that's weaker. So you want to exploit the relative strength and weakness. So it could be the semiconductor ETF. It could be another semiconductor. But that's the posture that I would take for the future, is to be a little bit more insulated from what happens if this event comes to pass. Okay. And then there's Super Bowls coming up. We're only a week away from that, right, Dave? Mm-hmm. What's the risk? Well, a lot of people gathered together, some terrorism risk, but there's also political risk, as you know, from the what's everything. there's political risk as well as terrorism risk and everything else. I'm sure it'll be fine, but you never know. It's coming up. It's on the horizon. And then, the market always has these things like, well, whoever wins the Super Bowl, then it means the market's going to move this way and that way. And I don't know if that's entirely true, but there's some analysis on that. Now, moving on. This is the momentum ETF. So I've been asked the question, how can you figure out whether there's going to be like continuation of momentum or, like it's a risk on day, risk off day? So let's just think about this for a minute. This is the momentum ETF. Now its volume is, it can do 600,000 shares in a day. It could do more. Average is maybe 350, 400,000. It's not super liquid that way compared to other things that you could trade, but it could be a good reference security. But this is what's happened recently here on the daily. And you can see obviously the move that happened on Thursday and Friday, largely because of the mega caps, right? But I want to show you the weekly. So since its inception back here, it's been chugging along, and there's been periods of really high signal to noise. So in 2017, you could look at that after the election and so on. In 2016, and then we had this high period of very low volatility, high signal, and we've seen that again a few times. And then coming out of the whole 2020 here, where we had COVID, and we came out of the hole and rallied a lot, pulled back, and then we've been in a channel, and that's breaking out of the channel. So it probably wants to head back to test those highs. It's had a very sharp move just recently here. So that's the weekly on that. Here's the holdings that are greater than 1% by weight. As of Friday, these are the holdings. So there's a lot of very expensive stocks in it, right? But there are some that you could pull out of that are more tradable, than the $1,200 stock or the $3,500 stock, or even things over 400 get kind of problematic. I mean, you look at Lilly, how it trades now versus how it used to trade. I mean, it's now $667 a stock. So this is mostly technology and communication, but it does have Eli Lilly in there for healthcare. It has some industrials and materials and stuff. So it has a few others, but the composition is chosen for weight, for like what is moving momentum wise. So here's the top sectors: 41% in information technology, communications 14, industrial 14, consumer discretionary 10, and so on. Here's the fund characteristics, and here's been the performance year by year returns. So you can see 2022 was down, and then obviously 2023 was up. 2024 is also moving higher. But by the way, ARC over since the same, even though it's had craziness, it's about 12% on average now returns. And same with this one. If you average this all out, it's about 12%. So ideas: use MTM as an indicator. You can use your smooth indicators on it. Use MTUM and offset with sector spider ETFs, because you've got the sectors. You can figure out what you want to do in terms of weight there. Use MTM against a price-weighted index like Diamond, so you're looking for divergence or convergence. Use MTM against ARC. ARC is far more volume, of course, than MTUM. You could use MTM against a subset of stocks. For example, on the Monday, January 29th, this was my chart here of buying MTUM and selling Intel, Google, GE, Oracle, PGR, and TGX. Why those ones? Because they were in the price category, of less than $200, but also they were exhibiting relative weakness compared to MTUM. So this is the chart. So MTUM stronger. So it's 6 times MTUM minus or divided by 1 of each of those. So you could put equal dollars in all those, and you'd need to balance it out by dollars on the MTUM. But this is the chart for the day. And that was very similar to Friday, except that it was much steeper. And so every day you could look at, of these stocks here, which ones are exhibiting relative strength and relative weakness. And if you could, instead of buying these high flyers, you get exposure by buying MTUM. But what could you sell against it that's exhibiting relative weakness? So some ideas for you. And then here's, to close it off, here's ARC over that weekly period. So it had the same rally out of the hole in 2020, literally like right at the end of March there, and rallied just like the MTUM did. But you could see that it came all the way back, whereas MTUM held up and it only came back not even halfway. And then this thing is just flopping around sideways here. So very different performance. So between the two of them, I know people have used, say, the ARC funds for momentum, but it's not really a true perspective of momentum like the other one. This one has more kind of high in the sky fintech that one day, maybe in 2035, might work out or not. So there's a lot more risk. Not to say that some of the ideas are that bad. It's just more long term, versus the other ETF is exploiting more current momentum, and it's balanced quarterly. And so they're looking for stocks that are exhibiting. Hope that helps you guys. I think that's it.
Right.
We're all done. All right. Good trading, everyone. Thanks.